big risk to earnings season is that earnings disappoint. Earnings estimates right now are very elevated. Wall Street analysts are very optimistic about earnings estimates growing at about 20% annually between now and the end of next year. So that's a very, very big increase in earnings for an economy that's growing at roughly about 1.5% to 2%-ish. There's kind of a disconnect there between earnings reality and what's happening in the economy. So again, that's going to be one of the kind of the defining factors over the course of the next couple of months as we start to get into earnings season, is pay attention to what companies say.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of yet another week with my good friend, the simple-minded Lance Roberts. Lance, how you doing?
That's the most accurate description you've given me in weeks.
Well, I'm glad you didn't take offense, and I meant it positively because you've had your new SimpleVisor service on your mind for a long time as you've been bringing it towards the finish line. So therefore, it's simple and it's on your mind. All right, and we're actually going to finally deliver the long-awaited walkthrough of the new SimpleVisor service. So folks, that is coming up in a bit. But Lance, interesting week in the markets here. Maybe we can get started pretty quickly with our regular charts and whatnot here. But we had some data come out this week. So we got the new CPI data. It was slightly cooler than was expected, and that was enough to get the markets jumping. We had the Fed obviously come out and give updated guidance, and Jerome Powell at his press conference. And even though they didn't really change anything except a little bit of their dot plot expectations, they basically moved an expected rate cut from this year into next year. Markets, seem to like what they hear. So we've got that. We've got some interesting things going on in France that is rippling through the bond markets, which we'll talk about in a bit. But what do you want to say about the week here?
So, well, first of all, on the inflation front, CPI and PPI came in cooler than expected. And the good news for that is that is also going to likely feed into a weaker core PCE. So that's the personal consumption expenditure component. Then that's really the thing. The Fed really doesn't, they do, but they don't focus on CPI. They don't focus on PPI dramatically. It's really that personal consumption expenditure index, the trimmed mean PCE. Part of that is also reflects into the core. So that should be a bit lower at the next reading, which should start to confirm. And again, we just seen this through a whole plethora of data this past really 3 weeks. And I've written a couple of articles on this over the last couple of weeks. Last couple of weeks of newsletters have touched on this kind of this pickup in the data as of late that is coming in weaker than expected. And again, that slower economic environment will ultimately feed into a disinflationary binge in the economy. And it was interesting because even Jerome Powell picked up on that in his conferences. So, specifically to your point about the dot plot, and kind of initially, the bond market was up really strongly going, as the Fed announced their meetings. We had a super strong 10-year auction this week. We had a stellar 30-year auction this week. So bond prices have been moving up very sharply. Yields were dropping. And so we had a very sharp uptick in bond prices just before the Fed came out and dropped their dot plot, which is part of their economic projections that they release once a quarter. And of course, the bond market knee-jerked a little bit on that because, again, it's one rate cut versus two. But Jerome Powell addressed that. He says, look, just understand that this whole thing is a big moving target right now. And I'm paraphrasing, but this is going to change. What is on this dot plot today may not be there in the next meeting, and it may not be there in the September meeting. We may be at 2 or 3 rate cuts come September. It's all going to depend on the data. And if the data continues to slow, then that dot plot is going to get drugged forward. So he made mention of that. He also noted that unemployment, and this is not surprising, that employment was likely overstated. And that was really kind of a big thing, because this is an election cycle, and most of the time the Fed would come out and say, yeah, the data looks good, or it's understated. not overstated. This is something we haven't really heard much of before, but coming out and kind of confirming what you and I have already talked about kind of ad nauseum for the last, next to the pig and the python, the unemployment thing has been, the big conversation. That these numbers just didn't really jive with the reality, the differentials. And I wrote on this in this last weekend's newsletter at realinvestmentadvice.com, going through, full-time employment, part-time employment, et cetera, native versus domestic. And, there's clear evidence that the employment environment is substantially weaker than what the headline suggests. So, it's all kind of feeding into the data now.
So let me latch onto that because obviously I did note Powell's comments there. Now, just for folks that didn't watch the conference, he didn't come out and pound on the table and say, "Oh, these numbers are overstated."
Yeah.
It was very, very indirect.
Yeah.
Where he basically said, and yes, there's some discussion as to whether these numbers are potentially overstated, and then he just sort of moved on.
Yeah.
But everybody picked up on that, and maybe that's high drama in the way that these these discussions happen. These small signals are sent at very high levels. But I can't tell you how many times he said strong jobs market or very strong jobs market. So I just don't want to get the folks the sense that he's out there visibly ringing the warning bell. He's still leaning pretty hard on this jobs data, although he gave a nod to the fact that some of it might not be as firm as he'd like. That said, he started this, I think, the last Fed meeting and repeated it this time when people would ask him, what would it take for the Fed to cut rates sooner than expected? He brings up weakness in the job market, and he keeps talking about how the jobs market has come into better balance, which is sort of fancy Fed speak for it's weakened, right? Because it was super hot and super tight, right? So he does sort of seem to be preparing us potentially in the future to say, hey, everybody, I'm cutting sooner than I initially told you. And it's because the job market's starting to roll over here.
Yeah. And that's really it. And that's why he was talking about this dot plot. Everybody's been focused on the dot plot. And and I think I think there were two takeaways from really that speech. Is one, I think a lot of that speech was kind of tailored towards the market, saying, "Hey, quit just reacting to everything we're doing. This is we're guessing at this thing as to where the economy is going to be by the end of the year." And the markets have just been so laser focused on every word, every period, every dot, every comma. It's just, oh, did they say this or did they really mean this? And the markets are just gyrating all over the place on expectation of these rate cuts. And I think a lot of that message was simply, hey, back off a bit, buddy. Give me a bit of room here to work. And we're going to try to navigate this as best we can. And then I think the other side is that he is trying to make a statement that the economy is slowing down without freaking the markets out, right? Again, the markets are so hyper-focused on every word, every statement that he makes, that he's got to be very careful what he says. Because again, if Jerome Powell, can you just imagine if Jerome Powell came out at me and says, you know what? I think that we're going to have just a massive recession this year. There's just no way around it. I mean, it would
happen that afternoon. Yeah.
Yeah. Exactly. Yeah. I mean, we'd be down 5,000 points on the Dow. The economy would crash. It'd be terrible. So he can't say stuff like that. So he's got to kind of give these nuances. And this is why we pay so much attention to all the Fed speakers when they come out, because that's really the messaging. So over the next couple of weeks, pay attention to what the Fed speakers say when they come out of, now that they're out of blackout again, we'll start having more speeches from them. But see if they start talking about maybe a little bit weaker environment, the need to maybe cut rates, more than once this year, that type of thing. Look for those little trial balloons that they send out there, because that's what the market will be looking for.
So, I recorded 2 videos recently, one of which is already out, where Axel Merck, who has followed the Fed very closely his whole career, he actually has an ex-regional Fed president as an advisor to his company. And Axel all the time says the Fed just talks way too much. He just said, he's like, look, a couple decades ago, like most people on the street couldn't name the Fed president, right? And now everybody, or Fed chair, now everybody hangs on, every syllable of the Fed chair. And he said, we oftentimes back then didn't even know what the Fed, they didn't announce Fed policy changes. Right. You found it out, kind of as it started to creep into the economy. You'd have to kind of back your way into it. And
And that's a big, that's a huge change, by the way, that has made the markets worse, not better.
well, exactly. And so he just thinks not only should we not have like, weeks where we get like 24 Fed speakers out there, and of course they're all saying different things and trying different trial balloons and stuff, so they're confusing the markets and the markets are pivoting and everything. But he's like, like Powell didn't have anything useful to say on this press conference. The only things he could say are going to potentially get him into trouble later on when what he said he thought might happen doesn't happen, right? So he's like, they should just do away with these press conferences.
They should. They should. Look, the Fed should be in the background doing whatever they do, right? If you're doing QT, great. If you're doing QE, great. We don't need to know about it, right? The markets will know about it, and that information will get out through sources, right? I mean, because obviously, if the Fed's doing QE and they're, buying buying bonds from the banks, that's going to get out. That data will be out there.
Right.
But we don't need it in the headline every day. We shouldn't be, this whole market rally that we've had ever since really the bottom of the market in October 22 is all driven by Fed narrative. It's not fun, and again, this is why we don't trade on fundamentals. We don't trade on earnings. It's all about the Fed. It's all about monetary policy. That all needs to be behind the scenes, some magician pulling strings somewhere. And again, to Axel's point, he's absolutely right. When I was coming up in the business, you talk to anybody, they didn't know who the Fed chairman was, much less did they know who any of the regional directors were, much less did they even know there was probably a Fed regional bank somewhere close to them. It's just nobody knew. No, it wasn't that. You got the Wall Street Journal. You read in the Wall Street Journal what General Electric did or what ExxonMobil did or whatever it is. You went and bought your investments, and that's why the average holding period was 6 years versus 3 months today.
Yeah, and I'm speculating, and I think what happened is the Fed, like these things tend to happen, it found out that it could kind of get something for nothing and then leaned into it and then created this Frankensteinian system it can't extract itself from. But I think it learned probably early on, hey, just by talking, we can actually drive a lot of the policy objectives that we want without even having to do anything. Right. And then now it's metastasized into, as you said, this system where zillions of computer algorithms are parsing every single syllable that the Fed says and trading in real time based upon those syllables, right?
That's right. And again, I don't think that's made the markets better. It hasn't. It certainly hasn't, created a better environment for investors to be long-term investors. And those are the things that have really made things so much worse for the average person because again, the whole goal of investing is to take our hard-earned savings and invest that into the markets and then hopefully grow those savings at the rate of inflation over time. And that's the way it used to be. And now we've just basically transferred the whole market environment into a big giant casino of how fast can I get rich, how quick. And we've totally done away with the basic principles of investing and growing wealth. And again, this is why, again, you and I have just talked about these statistics over and over and over again, but this is why there's such a big wealth gap in America.
Right. Well, and also because the Fed policies reward the rich, which we've talked about a lot.
But it rewards the rich who are the ones that invest, right? The bottom 80% don't invest. So
well, I was also going to say too, like, investing should be, and we sound like two old men,
we are old men
yelling at the kids to get off our lawn, which we probably are at this stage. But you could control, at least to the best of your ability, your success rate at identifying companies that are undervalued on a fundamental basis, buying them at a good value, and then riding them to the point where the market realizes it was mispriced and rides them up, right? But as you said, markets don't trade on anymore. They trade on, everything the Fed says. And it's really important to remember that the Fed has a horrific track record, right, when it comes to predictions, right? So, these algos are reacting in real time to a lot of information that on the vast majority of it proves to be inaccurate anyways in the long term. And Powell, and this is what Axel was talking about, Powell getting himself into trouble. So you may be right, Lance, that he's sort of trying to send micro signals that, the economy is slowing and we should prepare for it. But at the same time, he's putting out the Fed's projections and says GDP should be, 2.1% by the end of the year and then 2.0% average for the next couple of years. That the unemployment rate, which is currently at 4, it's just risen to 4.0%. He says, we think it's going to stay flat through the rest of the year. and it's going to go up just a smidge, right, for the next year. And if he's really expecting, or if we do have, any sort of material slowdown in the country, good luck with that, buddy.
Yeah. Well, and again, so by the way, let's just add, so for my 2028 presidential platform, on that platform list is, restricting, we're going to get rid of stock buybacks. We're going to outlaw those again. And we're going to add to that list now that we're going to put the Fed back behind a closed curtain, right? We're going to put them in a box. You're not going to hear from them anymore. And so that's going to be also, we'll just add that to the list of our to-dos.
Let me ask you this, and this I won't let us get too diverted here, but let's say it's not a presidential election. Let's say we make you dictator for a while. Beyond setting up a harem for yourself.
That's too much, dude. That's too much work. I have enough trouble just keeping up with one. My wife is all I need.
I think the older men get, the more they realize that fantasy, is more problem than it's worth. But would you even have a central bank? What would the role, if you had one, what would the role of the central bank be? Would it purely be a lender of last resort during emergencies? Would you even have one? Would you let the market set interest rates?
Well, look, you could make the argument for a central bank, but I think central banks have just gone way too far, not just domestically, but globally. They're involved in way too many things. Go back to day one. Platform item number one is to return the vast majority of the power back to the state. So the only thing the government's going to be involved in is national security and infrastructure. That's their job, and the central bank is basically there just to make sure that infrastructure and national security continues to operate functionally, and to make sure that banks are solvent and those type of things. And again, when we start talking about banks, we're going to return back to all of the mark-to-market accounting for banks. We're going to make sure that their tier one ratios are actually tier one ratios, that their leverage isn't 10 or 15 or 20 to 1. It's going to be 5 to 1 leverage ratios at max, maybe even less than that. We're going to break up the major banks. All the major banks will be broken up regionally so that they are basically on par with the major regional banks. That'll reset our financial system back to where you don't have 5 banks controlling 60% of the banking industry. It'll be well divided, well diversified across the country to give people more access and more competition to banking services. Those, but see, the Federal Reserve and the FDIC can be an important part of maintaining that solidity of that banking system, and making sure that the financial system is functionally operating the way it's supposed to. I'm okay with that. But when you start coming out announcing monetary policy and doing all these very things that are influencing the financial system, that's where you've gone too far.
Okay. All right. Presumably in your banking system there, the bank gets into trouble. Hey, buddy,
you're on your own.
You're on your own.
There will be no more TARPs, HAMPs, HARPs. If you get yourself in financial trouble, you get yourself out of it, or we have a bankruptcy system for that.
Right. And so presumably Fed, FDIC, their role there is to step in and make the dissolution of the troubled bank orderly. Right. That's right. But that's pretty much the limit of their powers there, is what you're saying.
Right. And that's what the FDIC does. And they've done it in the past, and they do it well. If JP Morgan went bankrupt tomorrow night, and this was always my big argument about 2008, right? It's just, oh my gosh, if a bank, they're systemically important. If it goes bankrupt, if GM goes bankrupt, it's going to destroy the country. No, all a bankruptcy is just basically you're going to court. You're basically shafting, you're liquidating your shareholders, you're restructuring your debt, and then you come back out of bankruptcy and you continue on down the way. In the banking system, it says, okay, Adam Taggart's bank goes bankrupt tomorrow morning. All his accounts are now the account of Lance Roberts' bank, and I've got all your customers, I've got your deposits, everybody's fine and healthy, and basically you kind of deal with your creditors and your shareholders as you unwind your business. And that's what the FDIC does extremely well in doing that. And we just need to get back to that system. There needs to be that thread of failure to clean up some of this kind of more egregious actions that these banks take. And I mean, again, JP Morgan's constantly getting in trouble or Wells Fargo, constantly in trouble for manipulating markets, or Wells Fargo for taking advantage of customers. And they pay a penalty. and then they just go on. Those penalties are taxes. If I can make $1 billion shafting my customers and pay a $200 million penalty, why not? That's a tax on revenue. I'll do that all day long. And that's why we never fix these problems. They just keep repeating them and over again. And as soon as something goes wrong with them, like we're going to now provide, payday credits and all this other stuff. When something eventually breaks on that, these buy now, pay later schemes, when something blows up, oh my gosh, we got to bail them out. No, that's all on you. That's my plan. It's all, you did it. You got yourself into the trouble because you didn't bail me out when I got in trouble. So you deal with it.
All right. Well, look, hopefully we have some, hefty political power players and some super PAC administrators watching, and they recruit you for the 2028 platform, because that all sounds really good to me, Lance. Okay, so you mentioned bonds real briefly. We are going to bring up the S&P charts in just a sec, but so a couple things about bonds. One, you mentioned that prices have been going up, and that this actually sort of started before the Fed announcement, but the Fed announcement, high for longer, which is essentially what Powell is still saying, right, is not good news for the banks necessarily, because it just continues to keep them underwater on their underperforming loan portfolios. But interestingly, just like he was, telling us how very strong the labor market still is, Powell was saying that the banking system is in good shape. And basically said, hey, it had a little indigestion a year ago, but we stepped in, we fixed everything. Everything's doing just great. So don't worry about banks, folks. I think that stands in pretty stark contrast to most folks, at least that I've interviewed on this channel, who are close to the banking system, where they're not saying it's on fire, but they're saying, there's some real worries there. And if you look at the unrealized losses in the banking system right now, they're massive compared to historical levels. And everyone's just kind of crossing their fingers in hopes that banks can all hang in there until the Fed cuts rates to some point where, the bad loans that are or the underwater loans in their balance sheets, start coming back up here. But
wait. Hold on.
Yeah.
There is a huge difference, about what's going on today versus historically, right? And I hear a lot of these comments, right? So they're trying to reference back to 2008 and that potential risk to these banks. And yes, there's certainly some of these banks that have collateral issues in terms of their collateral is underwater, but a lot of this collateral are treasuries. And when the Fed stepped in last year and opened up that bailout program, the bank term funding program, there was a lot of switch into treasury collateral. So yes, the treasury collateral is underwater, but all I have to do is hold it to maturity. It's not like I've got loans that are in commercial real estate on the verge of getting, that are going to go belly up, because again, as I've told you before, these banks have been doing a very fast pace of getting rid of that bad collateral as quickly as possible, even if they're liquidating it at 20, 30, 40 cents on the dollar to get it off their books, because they're trying to get ahead of that potential risk. And so everybody kind of keeps looking back at 2008, where we were surprised by the subprime mortgages. They kind of all fell apart at once because of the bankruptcy of Lehman, and nobody wanted to, no counterparty wanted to trade with anybody else. That's not the environment that we have today. Banks are operating fairly efficiently. And sure, there are some stress because of higher rates, but a lot of that's in treasury-based collateral, which isn't really a risk.
Okay, so agree that this is the underwater nature of the bank loan portfolios by itself isn't nearly the existential risk that it was during 2008. But it is a vulnerability, like you said.
Sure.
I mean, it required the Fed and the Treasury to step in, right? And a lot of those loans are hanging out on the balance sheet of the BTFP right now, and will come back to the banks within less than a year at some point, right? And everyone's hoping that rates will be lower by then, but there's no guarantee, right? We also, a lot of those banks have commercial real estate loans on their balance sheets that are much more toxic, and TBD what the impact of that's going to be. But it's another risk factor that's out there. But where I'm going with all this is, I think people are beginning to get a little bit more jittery about risk. And then you have what's going on right now in Europe. And the surprise there basically was that Macron, the Prime Minister of France, right? Prime Minister, President, feel terrible, I can't remember which he is, but runs France, and basically had to call snap elections because his ruling party is basically losing pretty hard in the polls now, losing the most to the nationalist faction, which is
Conservative.
Marine Le Pen's party. I don't think she's running as the candidate for France because I think she's more at the EU level now. I'm showing my ignorance of EU politics here, but basically, all of a sudden, that has really spooked markets that we may have unexpected regime change in one of the EU's largest players, and that's starting to sort of infect other bond markets in Europe. And I've seen more headlines recently too of people saying, "Oh my gosh, the market's sort of waking up to the fact that the Europe debt problem, none of its problems have gotten solved. They've kind of just been papered over, and now everyone's beginning to realize, hey, all that's different is we have a lot more debt right now, and we're now starting to see fracture lines, across the EU as more nationalistic candidates get into power, and when they do, the EU is potentially at risk at not operating as a single entity, but you start having these, individual factions that are saying, well, hey, my country's needs need to come first. So, all of this means money is running to safety, which is bringing the bond yields down here in the US at least. That's obviously got to be good for your long bond trade. So anyways, anything you want to comment about what you're seeing in terms of those different dominoes, I'd love to hear, Lance, but also this has got to make you and Michael Leibowitz feel, pretty good about your bond position right now.
Well, no, I mean, this is stuff we've been talking about for a year and a half now. That's, first of all, this whole idea that there's this de-dollarization issue that's going on, or, the dollar is going to lose reserve currency status is all pretty much hogwash. Because at the end of the day, when there is a risk of uncertainty, the first place you go to is the US dollar, because it's safe, it's liquid, it's deep, and you can, and even though we're doing a really good job of trying to destroy what rule of law we have left here in the country, it still has a better rule of law than just about anywhere else in the world, and particularly, Russia, China, Middle East, etc., where you may or may not ever get your money back. You don't know, because the government just says one day, hey, I just think I'll keep your money, which has happened. It happened in Malaysia is a good example. So, again, but this all goes back to, yeah, look, there are problems globally that are going to mature. And, we're going to see probably, what's happening in France is probably going to happen in Germany. It's probably going to happen in other EU countries, because this is the failure of socialism coming to roost. People are figuring out that all these socialistic ideas, mass immigration, green energy transitions, have not made the world better. It's made the world worse. And now these more conservative politicians that believe in, state sovereignty, national sovereignty, that, protect your country first, are gaining a lot of traction, because people are going, look, my life is not getting any better. This all sounded wonderful, in the beginning. We're going to have all this socialism and it's going to be fantastic and everybody's going to be equal. Socialism does not make people equal. It makes people very unequal and less prosperous. And now that that's really starting to come to fruition, we're seeing it here in the United States. We're going to see, and we're seeing it in France. We're going to see it in Germany, most likely. And that's going to put the EU. See, the problem with the EU was it was a great idea, grand experiment. The problem with the EU is they never had a monetary union. They just had a union. They said, okay, let's all be together, then we'll figure it out later. But they don't have a monetary union. In the United States, we have 50 independent countries, theoretically, right? But we all use the same currency. We all have the same central bank. We all operate under the same set of laws. And so Europe said, hey, let's be like the United States. That system apparently works really, really well. Well, they never put the monetary constitution behind it, right? And so you still got all this fractured system that goes on. You've got people kind of doing independent things. And this is now leading to the problems that the EU has. And, there was always a question about the survivability of the European Union as a union.
Right, from day one because of that, yeah.
Yeah, and we'll see. But maybe everything's fine and it goes on. Maybe and my question is always, the one value of the United States is that we can print our own currency, and there's good and bad to that. And so I'm not saying you should just go willy-nilly just go print a bunch of currency, but when you control your currency, you have a lot of independence about the things that you do. And one of my questions for the EU has always been, when does Germany wake up one day, or France or somebody else, and say, you know what, I'm getting off this euro dollar thing. I'm going back to where I can control my currency. I'm going back to the franc. I'm going back to the Deutschmark, and where I can control my outcomes. I know what my debt is. I know what my monetary needs are. And if we start to see that move where people go back to saying, hey, I want my sovereignty back, so to speak, and that will be the fracture that ends the EU. And that's not happening right now, but that's going to be the question.
It's not, but you had a precursor to that with Brexit. You have at times seen other countries there either threaten to leave or concerns that other countries are going to leave. So it will be interesting to see, to your point, Lance, if the momentum of the populace, demands and who they're beginning to elect into power continues to go along the path that it's on. It's much more nationalistic. Yeah, be interesting to see if we start seeing those come to the forefront again in recent years, in coming years. All right, but anyways, so this seems to sort of, again, buttress your bet on longer dated U.S. Treasuries, as to a certain extent, I think, not that he changed all that much, but I mean, Powell's, his statements this week, basically are saying, hey, we're feeling pretty good, right? I mean, they had more optimistic language in the actual written Fed guidance this time around inflation. And Powell basically said, look, we feel like we're winning the war. We just want to be super conservative. And so we're not going to cut until we have like overwhelming confidence that inflation is going to hit 2%. Didn't move off the 2% goal. But basically, mentioned that, gave the little indicators that you mentioned about weakening economy, weakening labor force, which is sort of a sign the lag effect is beginning to kick in from these higher rates. So I'm assuming, correct me if I'm wrong, but I'm assuming that this is making you feel fine about your bond position.
Well, so again, Fed rate cuts have nothing to do with our bond position, right? Inflation has nothing to do with our bond position. The reason is that...
Well, wait. I want you to answer, but just on that comment, I mean, Michael Leibowitz says, hey, interest rates are a function of inflation expectations. Well, we expect inflation expectations to come down.
Right. Okay. But that's what I'm about to answer for you.
Okay.
So inflation is the byproduct of the other things that drive our long duration, our thesis for our longer duration bond trade over the next 18 to 24 months, which is it's economic growth and wages that ultimately drive where yields go, because inflation is the byproduct of wages and economic activity, right? So inflation is simply supply and demand. That's all it is. So if economic growth is slowing and wage growth is slowing, which means I have less demand in the economy, then businesses that are pricing products or services have to cut their prices and service costs in order to continue to sell product, because I have to work within a lower demand economy. So the main drivers of the bond trade are economic growth and wages. Inflation is the measure of that activity. So that's why there's and I've got some charts on this we can go through here in just a little bit, but that's why, inflation as a function cannot act all by itself. It's very much tied to economic growth and the underlying economic activity.
All right, but back to my question of you,
which also a part of unemployment.
You're feeling pretty fine though about.
No, I mean we've never not felt fine about our trade. It was just a function of time, right? And we've always said that it's like, hey, this is 20. When we started this trade, it was 24 to 36. We're now 18 to probably 30 months now, because we've moved forward in time. But yeah, it was always just a function of time until the impact of monetary policy started to run in reverse. And there were some things that drug this out for a bit longer. This weekend's newsletter actually talks about why inflation has been stickier than anticipated. And there were just things that happened that X those items, we would probably already be in a much more deflationary state in the economy. But, Fed funds at 5.5% created a massive amount of income for households through certificate of deposit rates, money market savings rates. They had additional income coming in that helped them sustain their spending longer than we would have anticipated. But, that was a factor that we didn't build into our forecast. It was like, it was like, oh man, I just kind of missed that one. The other side of that is that, we had all these other, and you and I have talked about this before, but everybody was expecting a recession in 2022. And we said, hey, that's not going to happen because you got the Inflation Reduction Act, you got the CHIPS Act, you got all this money that's being dumped into the economy. So as consumers are running out of money, you've got all this other spending that's coming in from these acts. So that kept inflation stickier longer than expected because it kept demand elevated. But now we're starting to see those things kind of erode here, and we're starting to see demand actually come under pressure finally.
Okay. All right. Well, I wanted to get into this part just because you and I both get asked every week, well, what's on with Lance's bonds? And given that bond yields are now moving downwards, I wanted to make sure that we touched on it. All right. Let's quickly get to the charts just so we can show folks where we are in terms of overbought, oversold, because last week, I believe, you said there was a short-term sell signal triggered. I think that was last week. It was a recent week. Yeah, week before last. And then, markets have hit all-time highs again this week. So just want to get a sense, are we still in a really oversold territory or not? Looks like we probably are.
Yeah, no,
sorry, not oversold, overbought.
No, we're very overbought. We were on a sell signal a couple of weeks ago, and I kind of warned that these sell signals are a little bit tentative when you're pretty much in a kind of a bullish trend of the market. The one big thing that really really kind of keeps this bull trend alive right now is we came down, we had this nice rally. We sold off a bit, triggered that sell signal, came down, tested that 20-day moving average, held that, and it rallied back to all-time highs. So that just confirms that bullish trend that we're in, and very much like we saw, between November and really kind of March of this year, the market would just kind of grind higher and just come down and consistently retest that 20-day moving average over and over and over again. It just come down, test it, and then move higher, test it, move higher. And that's that bullish kind of trend that we're in at the moment. And so again, the 20-day moving average, that red line, is real key here at the moment because we are overbought. Relative strength index is back to overbought levels. The MACD is at a very elevated level, even though we're on a buy signal. That suggests that probably upside is somewhat limited here. So I wouldn't expect the market to go, ripping off another 5% higher. It's possible, but with as overbought as the market is, you're going to have a bit of a correction first. So again, market sells off. We retest the 20-day moving average, rally again, and algos are now back into that pattern of buying the dips. So again, there's nothing to really change that right now. The market makeup looks good. Right now, we're kind of out of earnings at the moment. So we've got a little bit of economic data to work with, but we're about to kick off earnings season again in 2 weeks. Now, the one caveat to all of this, of course, is that the buyback blackout window actually started on Friday. So again, that doesn't mean that all blackouts, all buybacks end on Friday. It just means that we're now within that 2-week period before companies start to announce their earnings. And so they're now moving into their blackout period where they can't buy back stock prior to the earnings announcement. So over the course of the next 3 weeks, that will ramp up to where we have a majority of companies that are in that kind of blackout period. That's gonna limit the upside, potentially give us a bit of a pullback here, retest that 20-day moving average. Outside of it, maybe we test the 50. But as we get through earnings, and of course, the big risk to earnings season is that earnings disappoint. Earnings estimates right now are very elevated. Wall Street analysts are very optimistic about earnings estimates growing at about 20% annually between now and the end of next year. So that's a very, very big increase in earnings for an economy that's growing at roughly about 1.5% to 2%-ish. There's kind of a disconnect there between earnings reality and what's happening in the economy. So again, that's going to be one of the kind of the defining factors over the course of the next couple of months as we start to get into earnings seasons. Pay attention to what companies say.
Okay, and is this again difference between the mean and the median? So is that S&P earnings are expected to grow 20%, meaning it's going to be the top stocks, the NVIDIAs, that are growing earnings by you know, over 100% that are pulling everybody else up?
Yeah. So if you actually go back and look at earnings in the last quarter, all of the earnings growth came from 10 stocks. The other 490 stocks had actually no earnings growth at all. So, again, that's this bifurcated market that we're in. So yes, when you take a look at earnings expectations, the hope is that the bottom 490 is actually going to grow earnings a bit, but the vast majority of the earnings growth is going to come from the top 10 stocks.
Okay. God, it just shows what a crazy market we're in. All right, we got to keep all this pretty quick, but let me just ask you a question about buybacks. I know we get on this topic often. So it's a 2-week blackout period before they announce?
Well, it's the blackout period started on Friday the 14th, and that's just where it starts to ramp up. So every company has, and again, part of this is policy, part of it's the company policy. Like, for instance, I'll just give you an example. My wife's company is a publicly traded company. They have their blackout window is 45 days, but they're a very small company, right? So they want to make sure that they're, not having any manipulation of the stock price, because it's a very thinly traded stock. It's a very small company, but their blackout window is longer than a company like, say, Apple's.
Okay. And what would Apple's be? Just guessing.
I would probably say 2 weeks.
2 weeks. Okay.
Right? Yeah.
So is 2 weeks before
again,
earnings?
I don't know that. I don't know that for sure, Adam. I'm just guessing.
Okay. Well, let's even make it 3 weeks.
Yeah.
But my question is if it's a matter of just a few weeks, I mean, by the time you get into June, right, the beginning of June, you probably have a pretty good sense for how the quarter is going to be, right? And so my question is does this blackout window really make any real material difference, right? Like if you know if you get a pretty good sense by the beginning of the third month of the quarter that the quarter is going pretty darn well, you can do a crap ton of buybacking before you enter your 2 or 3 week blackout window, correct?
Right, and that's what they do. I mean, we've had in the last 4 weeks. So remember if you look at this chart, remember that back in March we talked about the blackout window. We said, hey, be careful, stock buybacks are about to dry up. And then we had the correction in April, and during the April correction we were down 5.5%. And you and I started talking about, hey, the blackout window is about to open back up, and sure enough, the market's taken off. That's because we've had the second largest amount of buybacks on record in the last 4 weeks. It's been huge.
Wow. All right. Well, look, we could get distracted on this forever, but yeah.
And don't forget, since 2014, 40% of the appreciation in the S&P 500 has come solely from buybacks.
Right. And I know that this is one of the many reasons why if you win in 2028, this will be at the top of your list of things to get rid of.
Exactly.
All right. So I also just want to note, so this video is coming out on Saturday, as it normally does. The video that comes out the next day, Sunday, is going to be with technical analyst Sven Henrik, who, by the way, Lance, agrees with you and Axel that the Fed is talking way more than it should. But Sven is an extremely reluctant bull. And he doesn't like this market. He thinks that there should be a big correction. But of course, his domain is the technical realm, which you guys use as a tool. It's pretty much all Sven looks at. And he basically says, and he's been saying this for a good long while, he says, the trends are intact. And while he can come up with the same litany of macro concerns that you and I can, he says, look, I think this is a game where you keep playing it until you actually see real evidence of breakdown, and then that's when you change strategy. And
I actually addressed this on our radio show this week, because Mike and I are fundamental investors, right? We look at companies, fundamentals, et cetera. And, I wish I lived in a world where I could buy a company that has just fantastic fundamentals. But if I had a portfolio of that, I'd be lagging the market so much right now. If you just take a look at the gap between the S&P and the S&P 500 equal weight index, it's just massive. And if you take a look at the gap, small cap stocks, the small cap 600 index, the Russell 2000, they've never gotten back to the highs of 2022. They're still underwater. They're still, quote unquote, in correction mode. And that's just this massive gap in the markets. And so what I was talking about this week is that it's great to talk about fundamentals and all these type of things. But if I had a fundamental portfolio, I wouldn't be on with you next year because I would have no clients. I'd be out of business because they'd all leave to go to some portfolio manager that was beating the market, right? Because we've tied the whole investing climate to beating the market. So, you look at our portfolio, what do we own? We own Apple, Microsoft, Nvidia, Google, Amazon. We have some other fundamental stocks in there that we like, but a big chunk of our portfolio is those stocks because those are what's generating returns. And if I don't own them, if I don't create performance, it's what's called career risk. If I don't create performance, I'm not going to have a business next year. And that's the problem that we've gotten the markets into, because now everybody is a performance chaser.
Right. Right. Which generally means that if you do end up having a period where fundamentals matter or reality intervenes, everybody is driving the car off the cliff, in the wrong direction at the same time.
Well, but now that's where hopefully, and we've done a good job of this in the past. So, in a good example, in March of 2020, the market took a 35% tank. I wrote an article in February that we were reducing our equity risk pretty substantially in our portfolio. So we've done a good job of historically getting out early or getting out early within the decline. So, we didn't top tick the market, potentially, but what my job really is going to be identifying when this market is actually turning. And I'm going to be late. We're going to be on here talking about the market. This is happening. We're breaking major support. We're going to be down 6, 7, 8% from the peak. And we're going to be talking about reducing risk, pretty substantially at that point. And maybe more than that. I've got an article coming out this week talking about valuations. And, what's crazy, if you take a look at this chart, here, let me shrink this a little bit, get a little more time frame in here. But if we go back and look at this market going back to, essentially the 2019. So yeah, I'm actually writing an article right now for next week. It'll come out Tuesday, talking about mean reversion valuations. And the premise of the article is that because of all these monetary interventions, because of the economy, because we have been growing, that we've permanently lifted the valuation median, right? The median valuation. And so I go through some analysis in the article talking about, okay, if we have a mean reversion in valuations, assume the price of the market, so price to earnings, right, is price of the market, 5,300, use $217 a share, which is the end of this year's expectation for earnings. And that gives us our current PE, right? And so if we say, well, if we're going to revert the market back to the median valuation, there's several levels that I go through. I go through 3 different levels, but the most extreme is the 15.5% valuation of the market that's been here really since about 1990 now. That's a 40% correction in the market. And what's important about that is that doesn't even break the bull trend of the market. We're still in a bullish trend, even with a 40% correction. So, this is how far deviated we've gotten from long-term growth trends in the markets because of all, you can see starting in 2019, coming out of that and going into 2020, the markets just took off. We had that correction, and then the markets just rallied more because of all the stimulus and interventions that we've done. And we're so deviated from that long-term trend, it's going to take a very big correction in the markets at some point to get there. So again, we may be down 6, 7, 8% from the peak before we recognize that we're now moving into that cycle and need to significantly reduce risk to portfolios. But again, even a 40% decline is not going to break this bull market.
All right. Well, you're sort of setting up the scene for what I was going to mention from Sven. So Sven said, we are sort of increasingly facing a kind of 2 potential paths on the decision tree here. Either reality starts to catch up with this highly bifurcated, highly concentrated market, where you've got, really terrible breadth and a few companies that have been growing massively in ways that are hard to imagine are long-term sustainable, right? Like in the past 2 months, in less than the past 2 months, Apple has added a Tesla in terms of market value, right? Its
That's
market
correct.
value has grown more than Tesla's total market value in the past 2 months. And the stock is enjoying, a nice run this week because it announced Apple Intelligence, right, which is essentially a product that Apple didn't create, didn't program a line of code for. That doesn't apparently, I don't think it's going to be charging its customers for it. So, will AI transform the Apple iPhone and Apple product set? Who knows, maybe. But anyways, the market continues to seem very happy to give the benefit of the doubt to the Magnificent Four or Five in terms of just how that trees may really be able to grow to the sky this time around. But anyways, so that said, either there's going to be some reckoning out there, like you just mentioned there, Lance. Correct 40% and still just be back at long-term trends. He said, I hate to say this, but I can make the argument, and he then went on to make it, that the S&P could hit 9,000 by 2028.
Yep, that's very possible.
Yeah, which seems unimaginable in certain senses, but if you just extrapolate, certain trends, it's really not. Like I said, Sven goes through all that. So there've been people out there past year or so ringing the bell for S&P 6,000 and whatnot, which seemed outlandish at the time. Now potentially achievable. And look, Lance, predicting is a mug's game, but I bet you'd say, yeah, at some point we're going to see S&P 6,000 or 9,000. It's just a matter of timing. What kind of risk do you, or not risk, probability do you put on sort of like a nearer term melt up to levels like that?
It's again, like you said, it's kind of a mug's game, but I think you have to give right now, because of where we are within the cycle of what's happening. And again, the Fed's going to cut rates. They're going to reduce monetary they're going to reduce monetary tightness, right? So they're going to be, starting to reduce their QT balance sheet. And this market is so geared now between algorithms and Robinhood trading apps and everything else. The speculation now has become such a mantra for the markets that, again, there's the momentum behind the market has been amazing, and there doesn't seem to be much right now that can stop it outside of a pretty significant recession. And look, I want to be really clear about this. When we talk about recession, immediately everybody says, "Oh my God, financial crisis." No, financial crisis was, yes, there was a recession involved in that process, but the financial crisis was a function of credit markets. The recession, just an economic slowdown, which is a reversal of economic growth, will impact earnings. Markets will reprice for lower earnings. That doesn't mean everything has to crash, but a fairly significant recession, say you have a recession of 1 or 2%, this market's going to be down 30, 35% because it's repricing for a slower earnings growth environment and repricing expectations to reality. And again, we're so deviated that a 30% correction would not be anywhere outside the realm of normality.
And this is, I want to get to SimpleVisor, so I don't want to get hung up on this, but we've talked about this a bit. Like, a financial crisis is sort of the natural equivalent of a meteorite, right? It's like something that comes along very rarely, but is devastating when it does, right? And yes, we should all, do whatever we can to figure out, planetary defenses against a meteorite that's going to slam into Earth to see if there's anything we can do about that. We probably can't, but whatever. But a recession is like winter, right? It's just part of the natural cycle and it plays a role, right? And yet we've somehow evolved over the past 20 years or so to treat recessions like they're meteorites versus winter, right?
Right.
And of course, by doing everything we can to delay the winter, we actually increase its impact when it does arrive. And so it actually is going to feel worse when it does, because we've been trying to keep it at bay for so long.
Well, that's right. And again, this again, we go, like I was talking about with the banking system. We did all these things. We bail out companies, we bail out banks. We keep the natural order of capitalism from working. And again, we complain about corporatism, and everybody kind of everybody says, "Oh, it's capitalism that's broken." No, capitalism is fine. Corporatism is a problem. And that is where we fostered that through all of these bailouts. We didn't, if you would have allowed Boeing to go into bankruptcy because they spent 5 years of revenue buying back shares rather than, shoring up their balance sheet for a downturn in the economy when we shut down the
or
economy.
shoring up their plane doors. Yeah.
Yeah. Or their plane doors. Same thing with Royal Caribbean, all these others, right? They should have had cash reserves. On side, say, hey, you know what? Any good manager, we like in our business, right? We have a year's worth of cash reserves sitting aside in our business in case something happens, so we can pay payroll and we can make sure our employees are taken care of and those type of things. But we're always prepared for what happens if the market falls apart. What happens if this happens? We got to have reserves for that, because nobody's going to bail us out, right? If we get in trouble, throw us to the wolves, right? We're going to be in bankruptcy court, whatever it is, and we're going to have to fight our way through it. But if you're a big company, apparently that's a whole different ballgame. So as I was talking about before, we've completely created this environment where there's no risk to being a major corporation. So why not spend all my money doing buybacks and enriching my executives for companies? I don't need to worry about the future if I get in trouble, if I get into a debt problem, if I get into a shutdown problem. That's all right. I'll get a government bailout. And when we've come to this belief that that's all okay, rather than allowing the natural forces, the Darwinistic evolution of capitalism to work, which is the strong survive and the weak perish. We've got to start letting the weak, we cannot be afraid to let the weak perish, because it opens up opportunity for capitalism to operate at its highest level for everybody.
All right. I'm really liking this Robert's 2028 platform. I'm on it. All right. So now let's transition to the most important part of today's discussion, which is the overview of the new and improved SimpleVisor service. And Lance, as you're getting ready to walk us through that, maybe just a couple quick points of initial context here for folks. So as I understand it, SimpleVisor is great for the following people. If you are a DIY investor and you want to be captain of your own financial portfolio, fantastic. I just highly recommend that most people do that only if they are already experienced in that, or if you want to become experienced in it, great. But generally sort of train under a master until you've demonstrated that you've got a good enough track record to start putting the majority of your own capital at risk. And what's great about SimpleVisor is it lets people basically do that, right? So they can look over your shoulder, basically, whether they're experienced or just starting out. They can see all the trades that you guys make and why you make them. They can see all your different model portfolios, and basically they can pick and choose whatever they want and implement it themselves. So you're nodding as I'm saying this. So that's number one. Number two is people who want to work with a financial advisor and have a financial advisor manage their money for them, but they don't have enough capital yet where the financial advisor can really start doing personalized customizations to the portfolio. If you have below a certain amount, and I'll let you guide folks to whatever you think that is, it's better, as you've said many times in the future, to take a very simple approach and have a sort of starter portfolio where your job really is just to earn the money and put it away month after month, get it to work in the market in this time-honored, simple allocation. And then once you get to the point where you have enough capital where an advisor can actually help you with customizations, you kind of graduate to a managed account. And along that journey, you've developed the muscles to actually earn, save, invest, and you've kind of begun to learn the heartbeat of the market along the way. You're nodding as I'm saying this too. The third great set for this, I think, is kids, right? Who are basically just smaller versions of the second category, right? Where they're just starting out, but they have the biggest advantage of using time to their benefit, right? You've got the compound interest thing. And so, as a kid is starting out, getting allowance money, getting some initial job money. My daughter just graduated high school. She got a bunch of little, envelopes in the mail with $50 in it. They can start putting that to work. And by the time they really start earning an income and caring about their investments, they've already got a pretty good nest egg saved up. So are those, am I correct? Are those sort of the three target audiences for this?
Absolutely, and that's the ultimate goal. That we're trying to provide a tool that can help just about anybody, no matter kind of where you are in your life cycle stage, you know, depending on the type of investor you are, et cetera, that there's going to be the tools here to help you achieve that goal. And ultimately, you know, a full suite of portfolios, direct online access to your account, the whole 9 yards. So that's really kind of the goal of this ultimately, is to provide, you know, the way this came about was ultimately is like, how can I put me in a box? And you know, all the models that we use, all the things that we can do, can't we just provide that to people? And that was the genesis for SimpleVisor when it first started. And we've gone through several years of innovations and changes, and this didn't work and that didn't work, of course, to get to where we are now. And there's still a whole lot of tools we'll be adding in the future as well, of things that we use on a daily basis to help us navigate markets, manage risk, and to run our portfolios the way we, you know, to achieve the goals that we want to ultimately achieve.
Okay. Yeah, I remember the early prototypes where they were literally putting you in a box and FedExing you to people, and that one just didn't work at all.
No, the shipping cost was horrendous.
At least they remembered to punch air holes in there, though. That was
exactly.
Good. All right. So, well, do you want to just walk us through the new platform right now and the specific bells and whistles? And and as you're pulling it up, I just want to share my screen for a quick second, because this surprised me, Lance. I did a Twitter poll to my Twitter audience of about 80,000 people, and I said, "What best describes your investing process?" And look at the results here. The vast majority were DIY. I mean, I knew I had a lot of DIY folks that watched this channel. I guess I didn't realize how many did. And, you know, 78.8% say I do it myself and I like doing it myself. So, you know, I think there is a huge demand amongst this audience for tools that can help people be a more successful DIY investor. And that's one of the reasons why I'm so excited for you to walk through this.
Yeah, exactly. Because, you know, historically, DIY investors are the worst investors. They do everything wrong. They make all the emotional mistakes, et cetera. And that's really again, going back to the genesis of SimpleVisor, was to provide a process that you can use every day. And we've designed the whole website to be a process. You start at the first tab and you work your way through, and you go through each step to get to your portfolio decisions. So however you want to run your own portfolio is fine. But we want to provide you the process to go through. So just as we do every day, how do we start our day? Where to begin with? And from that beginning phase, how do we get to the portfolio decision of what we buy or ultimately what we sell? So when you first log into SimpleVisor, you put in simplevisor.com. If you're not a subscriber already, you're going to wind up on this page that basically says sign up. So you can review the front page. It explains what SimpleVisor is. Click the sign up button, and you're going to wind up on the sign up page. Now, there's a couple of important things here as you do this. Once you fill out your registration, we're going to ask you a couple of questions about your risk tolerance and financial profiles. We're collecting that information now. This is going to ultimately feed into our portfolio management structure once we get those portfolios launched. There's several menu choices that you can drop for the type of subscription. The base subscription is $29.99 a month. There's an annual subscription, the lifetime subscription, et cetera. So those are there. Once you put in your credit card information, now this is the important part, I get this email a lot, is if you are an international citizen, right? So we get a lot of people in Australia and other countries that want to use a SimpleVisor platform, but they go to enter in their credit card information and it won't work because it's an Australian credit card, or it's from Europe, or whatever it is. All you have to do is where it says town or city, type in whatever your town is, and in the state, just select any U.S. state. We use Stripe to process the credit card information. Any U.S. state, if you're an international citizen, will work, and the process will open up. So that'll get started now. You have a free 30-day trial. So once you get started, you have 30 days to use it completely risk-free. If for any reason down the road, within that 30-day period, you don't want to subscribe to the platform, simply go to your name in the upper right-hand corner, click on My Account, and go to Subscription, and you can cancel your subscription right there. Just click the Cancel Subscription button, and it'll cancel it for you. If you don't cancel it and you go past your 30 days, you will be billed. So just, you know, want to let you know that.
But that's pretty standard fare. Yeah,
Go ahead.
That's the standard fare with subscriptions, and 30-day free trial is quite generous. So
Right. And look, we want you to try it out. We want you to enjoy it and have time to really explore it. There's a lot of data on here. So let's just talk about the process. So you start, this is how we start our day, and this is how we recommend you start your day, right? You come in, what's going on with the broader market. So the first page, the home page, is set up just to give us a good idea of what's happening in the broader market as of the close of business yesterday. You can click on any of the indexes and see, what's happening in terms of it'll give you a chart. This is what the NASDAQ did yesterday. You can click on bonds, see what bonds are doing, the 13-week, the 5-year, the 10-year, the 20-year bond yield. Take a look at commodities of different types, even take a look at cryptos, what's going on in the crypto market. As you scroll down, we start getting into some of the more relevant information as to the market. So we have a heat map, and if you click on the heat map, it'll start to drill down into each section. So I clicked on technology, it drills down into the technology sector. I see Microsoft was up big yesterday. And so that will pull me into some analysis. We'll get into this to the stock analysis here in a moment, but it pulls me into stock analysis for Microsoft itself. On the other side, we have sector performance. So what's happening with each kind of the major market sectors, materials, financials, et cetera. If I click on one of the symbols, for instance, financials, I get an overview of the financial sector, looking at the ETF itself. So this is XLF as our representation of the sector. So now I get kind of an idea of what's happening in the sector. Where is it relative to its 52-week range? Is it closer to the high end of the range or closer to the low end of the range? Is there potential opportunity there? In the stock highlights section, we can look at stock highlights for the S&P 500 or the NASDAQ 100, look at the top 10. Adobe, obviously, the big winner today after earnings. I click on the symbol. I'm going to get analytics all about the stock itself. And again, I'm going to get into that a little bit more here in just a moment. Keep scrolling down. We also, one of the things that I want to know is like, what's in a market that we've got going on right now, where are some opportunities? What are some things I can kind of be looking at right now? So if I want to be a long investor or a short term or a short investor, I want to short stocks. We give you 3 lists: one based on an RSI index, one based on momentum, and one based on our measures of relative strength. And it screens every day, real time, and provides you 10 choices of the outperformers or the underperformers. So this is just the starting point, mind you, for finding opportunities, something to buy or something to short potentially, or maybe a stock you own is on the underperformer list. Maybe I need to go back and look at that to say, why do I still own this stock? Is something going on here that I need to be aware of? So this is just to help you start to really kind of focus your thought process. Of course, we provide all of our insights. You get access to our, all of our daily market commentary that we produce every morning. We provide 4 blogs a week, our weekly newsletter. We also provide specifically for SimpleVisor what we call our Friday favorites. And so this week's Friday favorites is on gold and silver. And so we go through those. Of course, latest news headlines, our proprietary fear and greed index, and our technical overbought, oversold indicators. And I'm going to show you more of these in a second. We have a whole section for these that show historical performance, but this kind of gives you an idea of where the market is. Is the market really overbought? Is it really oversold? Are people really greedy, or are they very fearful? This is updated once a week, so this is weekly data. So it slows things down a little bit. You don't get, otherwise the gauge would just be flying all over the place every day, which makes it hard to be a more stable investor. And then of course at the bottom, when you build your own portfolio, your portfolio performance will be listed at the bottom of the page. So you can go scroll down, see how your portfolios are doing relative to the markets, and navigate from there. So for instance, if you look at on the left, these are the SimpleVisor portfolios that we run currently. We'll have a lot more of these down the road, but the equity ETF model, or so the equity fixed income model, is down 0.2% today. The market is down about 24 bips at the moment. So again, it's performing a little bit better than the market today. Its overall P&L is up 43%. So it kind of gives you a comparison to look at as well, saying, okay, my portfolio is down a lot more than their portfolio, or my portfolio is up a whole lot more. So it just kind of gives you something to start to think about your portfolio and some things to take a look at. If we go to
one question, let's before you hop off that.
Okay.
I know one of the reasons why we were waiting to do this is because you wanted to get some of the other additional portfolios in place. You're still putting those together. Just if you could just name one or two of the type of additional model portfolios you expect to be in there.
Oh yeah. So right now we've got 8. There ultimately will be 10 altogether. We are building an accumulator model, which is a very simplistic a model structure for beginning investors. So if you've got $500 that you want to get started with, we're in the process of working on fractional share trading with Fidelity to be able to provide that. So you can have a very small amount of money, get started into a program to consistently save and invest. On the other side of that coin, we're going to have a dividend equity model that's a little bit different than the dividend equity model that we run currently. We're also going to have an artificial intelligence model, one based on infrastructure, one based on cryptocurrencies, also a small and mid cap portfolio, and also a focused growth portfolio as well, which is a bit more of an aggressive 100% equity allocated portfolio. So you'll have access to all of our portfolios plus 8 others. We're also going to have an all-weather portfolio, which is, kind of the I'm not sure if the world's coming to an end portfolio, but I've got a portfolio for it anyway. So we'll have that, and then ultimately my goal is to have a thoughtful money portfolio, and then we've got room for one more of whatever kind of thematic thing comes along that there's a lot of interest in. We'll build a thematic portfolio for it.
All right, and obviously a SimpleVisor investor could say, I'll put 10% in the AI portfolio. I'll put another 15% in the all-weather portfolio. I mean, they can mix and match from just the portfolios themselves if they want to, correct?
That is correct. Now, those would each be an individual account, right? So you'd open up an account for the AI model, and you'd open up an account for the infrastructure model. However you want to do it is fine. We have to keep the models separate in terms of accounts, because when the system rebalances the account, we rebalance the accounts every quarter. So when it rebalances, the system has to be able to see a clean slate of the holdings so it can rebalance against the target model.
Got it. But for the user, all those accounts are still with your firm, and so they're just dealing with one institution, correct?
Well, no, the accounts are all held at Fidelity. So Fidelity is the custodian in this case. We're providing basically the access to Fidelity through our system, but no, your individual accounts, they're not held. We don't hold any accounts. We're not custodians. They're all held by Fidelity. So not only will you have the reporting through SimpleVisor and through our partner advisor engines on your portfolio performance, the trades that are made, et cetera, we have full clarity and full visibility to everything that happens within the portfolio, but you'll also just be able to log into Fidelity yourself and your own online account with Fidelity and see all of your portfolios there.
Okay.
Yeah. Plus you have the insurance with Fidelity and everything else. So the next step is, so once you kind of get an overview of the market, this is how we start our day. And we say, okay, great. Let's see how the overview of the market looks. Okay. So the next thing is now a little bit different. We're going out and we're looking at all kinds of research from other people, but we give you all of our research. So all the research that we do on a daily basis that we can, and again, this is all of our writing, our weekly newsletter, our blogs, our daily market commentary. All we do is we just take all the research that we do and we put it in writing and we share it with you. So you have every day a full suite of video content, from our morning radio show to our daily blogs. Again, on the right over here is our SimpleVisor originals. We publish these every Friday. Our daily market commentary, you'll get access to that. So all this is available to you immediately in the morning. So you've got plenty of stuff to start going through to say, okay, well, what are the guys thinking about the markets? What do I need to be thinking about? Because we cover just about every topic you can imagine. There's not many topics, as you know, Adam, every week when you say, well, I talked to so-and-so about this. Yeah, I wrote an article on that last week. And that's because we are doing so much research internally that we convert into writing, because that's how it helps us manage our portfolios better. So you have access to all of that as well every day. Now, the next step is let's start talking about the markets themselves, right? So now we need to start drilling down a bit into the markets to start really looking for opportunities in the market itself. And so we can take a look. So the first step is just looking at the major markets. So with that, we can look at the S&P. The NASDAQ, the Dow Jones, the Russell 2000, the VIX index, they're all shown over here on the right. This is the performance of the peer group to the S&P 500. We also can look at the individual sectors of the markets, what's performing, what's having the biggest percentage gainers. Not surprising, technology, communications, those are the biggest winners as of late, versus the performance of each sector to the S&P 500 itself. And then we give you a technical rating for each one of these sectors. So as you click through each sector, we'll give you the technical kind of the breakdown. So for instance, this is XLB that we're looking at relative to, which is the basic material sector, relative to the S&P. It's currently approaching oversold. It's been underperforming the market. It's still, technically it's doing fine. It's got a strong technical rating longer term, but the MACD is getting pretty oversold here. So again, we may be getting an opportunity to maybe look at basic materials as an opportunity to add to our overall portfolio. Then we can step over and start looking at kind of major asset classes across different markets. So again, we take a look at the asset class kind of in general. So we look at U.S. bonds, international bonds, oil, commodities, emerging markets, international stocks, industrialized international stocks, emerging market bonds, gold. How is that? How are they currently performing? What's the latest change? What's working within the 52 relative range? Where are they on the technical basis of their 20-day, the 50-day, or the 100-day moving average? Same thing for global equities. Also into bonds, we can kind of again look at the 5-year Treasury, the 13-week Treasury, the CBOE interest rate index, the 30-year index for interest rates. What's happening with those? Also into commodities as well as to Asia Pacific. So no matter really kind of what you're trading, we get you kind of a brief synopsis of what's happening with all these different major markets and major asset classes. That drops us back into our heat map of the market. So again, kind of looking at the overall heat map of the market, what's performing, what's not performing. As I showed you earlier, you can drop down into each individual sector. We provide several different ways to look at this. This is also what we call our market x-ray. So this is the top and bottom performers by sector. So again, in the healthcare sector, you've got some stocks that are performing really well. You've got other stocks like Align Technologies that aren't. If I click on it, I'm going to start getting analysis on those particular stocks themselves. Same thing here as well, as that now we'll start to break down the holdings, give you a heat map of your own portfolio. So again, for right now, the SimpleVisor portfolios are my portfolios. So this is the breakdown of the heat map currently of my portfolio. So when you would click on your portfolio, you would see the heat map of your own portfolio and what's going on with that. So it kind of helps draw attention to what's moving and not moving in your overall portfolio.
That's cool. A heat map of your own portfolio. That's really cool.
So as I said earlier, we provide 2 gauges on the front of sentiment. So when we talk about sentiment, we talk about our fear greed gauge, which is our fear greed gauge, very different than CNN's. CNN actually includes the S&P as part of their analysis. Ours is, how are people actually allocated to the market? So again, how are people actually investing money relative to the market? So we build based on positioning and sentiment, how people are trading the markets. And that's where sometimes our fear greed gauge differs than CNN's because they're just different measures. But
right, yours is, let's not hear what they say, let's look at what they actually do.
Correct. And then we have a technical gauge as well, as I show you on the front page. We also provide quite a few others as well on this page. We have our SimpleVisor sentiment. So this is just a pure measure of sentiment in the markets. We have a strong buy sell ratio. So how many stocks are rated a strong buy versus how many are strong sell ratio. So we provide that as well. Typically, if you get a lot of strong buys and a lot of weakness in the sales, typically that means you're very bullish. If you get the reversal of that, typically things are very bearish, and those are typically opportunities to be in a contrarian investor. So if the markets are very optimistic, very bullish, maybe it's time to be a little bit more cautious. We also take a look at the number of stocks that are overbought or oversold. Again, if you have a whole lot of stocks overbought or oversold, that can tell you a little bit about the market. Importantly, something that's been a hot conversation of late has been market breadth. The number of stocks trading above their 50, their 75, their 150-day moving average, their 200-day moving average. Clearly what's happening right now is that despite the fact the market's going up, breadth is getting weaker. So we give you this gauge that you can look at on a daily basis is like, well, how's the breadth of the market doing? And then here's at the bottom is the fear greed gauge. Now, rather than just seeing the gauge, now you actually see the historical performance of the gauge versus the S&P. Same thing for the technicals. So again, these two are updated once a week. But what you can see is that when things are pretty elevated, that's typically near a peak of a market. When things are pretty oversold, that's typically a good buying opportunity. So this is where you can see that gauge kind of working in real time. And then lastly, we provide a whole lot of charts here or tables on different measures of stocks and sectors. So again, so now I've got a feel of the market, right? So markets are really overbought, they're very stretched, or they're very oversold, very bearish. Where do I want to kind of start be looking for some opportunities? So I can be looking at maybe let's go look at some stocks that are the most overbought right now. Maybe these are some stocks that maybe I should think about, maybe taking some profits in if I own them, or, if I don't own them, why are they doing so well? Maybe I can work on that. Stocks that are making all new lows every day. That's, stocks maybe I want to, if I own one of these stocks in my portfolio, maybe I want to go look at that and say, maybe there's something else going on. I like the company, but maybe there's something else happening here. I need to investigate more. New highs, same way. So we provide just numerous different ways to look at different stocks. We also do it for sectors of the markets, as well as ETFs themselves. So for instance, if you click on a sector, it's currently on materials. We could change that to say, healthcare. And we can look at the top 1 year performers for healthcare, the bottom 1 year, the top 1 day, the bottom 1 day in the healthcare sector. So again, the whole point is now to get you, so we got the broad macro to start with. I know what the market's doing. I know kind of what the sentiment is. Now let's get to work and start digging down into some stocks and start looking for some opportunities to either be long or short, whatever it is. And this is where it's going to drop us over. The next step is going to move us into our full functioning research. Now, portfolios, of course, is where currently you're going to go to see your portfolio. This is currently right now the 3 portfolios we run. The my portfolio at the bottom, that would typically be your portfolio of whatever you had built. When you log in, you will see these 3 portfolios at the top. You will see your portfolios that you build here under my portfolio. Coming soon, there'll be a second section in the middle of this, which will be the model portfolios that I was talking about earlier, the AI, the crypto, all those. You'll be able to click on those as well and see those portfolio allocations, what they're invested in, what they're doing, et cetera. So if I click on, for instance, if I click on the equity portfolio, we provide a lot of different detail on this. This gives you an overview of the portfolio itself. We can click on holdings, look at each individual holding of the portfolio, go through recent transactions, what's been bought, what's been sold. You'll see the same thing in your own portfolios as well. So you can go back and look, when did I buy that stock last? Or when did I add to it last? Or when did I sell it last? You can filter it and say, when was the last time that I bought Apple, as a good example. So if I type in Apple, I click apply, I see all my recent transactions. We sold Apple back in November of 2023. We trimmed it back to profits. We bought some back in January of 2024. So, you can kind of go back in history and look at when we bought and sold positions. And you can do the same in your portfolio to try to get an idea of, and again, you can see that we buy and sell Apple all the time. Now, we're not selling the whole position, right? We're just taking profits and adding back to it when it gives us a decent entry point over time. You can go into research, and I can look at any stock in the portfolio that I have and look at kind of research on it. We provide you different measures. My Hanoram score is a score based on 9 variables that look at momentum of the overall stock. Petrosky is a score that has 9 variables to it that looks at the fundamental quality of the company. So if I can have a company that has got a high fundamental score to it, technically it should perform better. The SV rank is our ranking buy, sell, or hold. So 1 is a buy, 5 is a sell. So again, because you go through those rankings. We also give you kind of the deviation distance from their stop. Is the moving average crossover bullish or bearish? And we give you some indications for that. Look at the performance of the portfolio over time. You can do this with your own portfolio. Look at the analysis for each one of the positions, again, looking at the rankings versus its 12-week performance. You can set up alerts for each stock that you own. So if something happens, it's a full gap up, positive volume, whatever it is, you can set up alerts. And when those technical indicators are triggered, you will get a notification that some alert has happened, and that way you can go pay attention to what that stock is. We also track all of the dividends and earnings of the company. So if you've got a company about to pay a dividend, it'll show you what companies are paying dividends, upcoming dividend payments, upcoming earnings. Right now, we don't have any upcoming earnings for any of our stocks because we're out of earnings season. But again, this just tries to keep you up to date as to what's happening with your portfolio. So jumping over to the, and you've seen these charts before that we've talked about. This is where we get into the actual research for the markets themselves and the things that we want to start looking for. This is where we want to look for opportunities. Where are things that are, very, very overbought, very, very oversold? What's in favor? What's out of favor? And again, if you take a look at technology, it's in the far right corner right now on an absolute and relative basis, very overbought. XLE is a good example, and this is why we added, as an example, we added to our energy exposure a little bit this past week, is because it's extremely oversold. And normally when things are down at the bottom left quadrant, they have a tendency to work their way back up to the upper right quadrant. And so again, this is going to help us start to make a determination of, kind of what to look at. So if I want to take a deeper dive into energy, I can click on this little icon next to that. And this is going to break down the energy ETF. It's going to give me the top 10 holdings of the energy sector ETF. And so did you see the top 10 holdings are ConocoPhillips, Chevron, EOG Resources, Marathon Oil, ONEOK, et cetera. And as we scroll down, it gives us the relative performance to the index itself. So this is ConocoPhillips as it relates to XLE. And then also how is its performance relative to each other within that index. So we can start seeing what stocks, even within the ETF, are very overbought or very oversold relative to the ETF itself. And so if I want to take a look at Phillips 66, which is moderately overbought against ConocoPhillips, but it is overbought relative to the index itself. So maybe this is something I might want to consider taking some profits in as I start to go down the road. Factor analysis, this is a bit more complicated, and we're going to ultimately have a separate video just to go through this in much more detail. But what we want to look at is we look at various factors of the markets to try to figure out what's performing and what's not performing relative to the overall market. Is growth outperforming value? Is small cap outperforming mid cap? Is international outperforming domestic stocks, et cetera? So we go through a wide variety of these different momentum, what we call factors, whether it's momentum, semiconductors, disruptive technology, equal weight index versus the S&P 500. And we can then look across the board. How has IWM, small caps, performed relative to the S&P over the last 5 days? It's underperforming by 2.66%, as you can see in that first column. The second column, over the last 20 days, adding to that 5-day period. So this is actually 25 days. So 25 days out, it's underperforming by almost 5%. Over 45 days, though, the performance has been a little bit better because we had a little pop in small cap, kind of small cap, mid cap index previously. So over the last 45 days, we've had some better performance, but it was very brief. And then we went back to underperformance. So over 6, because we're adding 20 days at a time, at 65 days, 125 days, 185 days, you can just see what the performance has been for each one of these. And we can look at factors. We can do sectors as well, exactly the same way. So we can look at XLP versus the S&P and performance. And then you can also build your own. So you can basically put in whatever stocks you want, put in 5, 10, 15 symbols, and you can see how each one of those stocks have been performing on a relative basis to the S&P 500 itself. So then I'm doing all this work, right? So we're kind of moving forward here. I can also start running screens, and we provide you some basic screens to run, but you can create your own screens of whatever you want. If you want to run, for instance, the 20 strongest relative strengths in the markets right now, you can run a list of stocks And we give you kind of the overview of those 20 stocks, the technical ratings of each one of those stocks, and these are the strongest ones, and the fundamental ratings. So again, now this is going back to, I've got to make a decision about what to buy. We're just going to provide you all of these tools to help you start to find what that is that you want to buy. So now, as I said earlier, let's take a look at applied materials as a good example. So I ran this screen, and applied materials comes up, and I say, oh, that's a very interesting stock. Let's take a look at that. Well, I can take a look at, for instance, in the overview, tells me what its 52-week range is, what its last close was, its performance relative to the S&P right now, which is very good. It gives me an annual dividend, gives me the dividend yield. As I scroll down, I can take a look at the revenue of the company on a yearly or quarterly basis, the earnings per share. I can get a quick measure on the business health. So let's take a look at the business health. Gross margins 47%, profit margins are 27%. I can look at stock transaction stats, how many shares outstanding, how many are floats, how much is held by insiders, how much is held by institutions. That tells me, again, if 83% of the company is held by institutions, I'm gonna have a lot of buying power in that stock. So again, stocks with very low institutional ownership tend to have trouble performing, because even though they may have a great earnings report, you don't get those 15 or 20% pops because you just don't have the buyers for it. If the institutions are heavy players in that, that's where you're going to get a lot better performance out of the stock based on news events that occur. Could be good, could be bad, but institutional and ownership is very, very important. What's the share float? How many shares are short? We've talked a lot about shorting in the past, and so understanding what the float is out there is important. Also, take a look at returns for applied materials on a week to date, month to date, quarter to date, dividends and splits that have occurred. Take a look at the earnings, and we're going to get more into this in a second. This is just a quick snapshot of what's happening with the stock. Of course, news at the bottom. Of course, you can get all the updated news. Click on the advanced chart button. We've built a basic chart for you. So when you are starting to do the analysis on your own stock, you can now look at that stock on a technical basis, provide you a basic, but you can build your own template. You can build your own series of charts that you want to use to help you identify, your buy and sell opportunities accordingly. For each stock, we also provide you a kind of a deep dive into fundamentals. So if you take a look at, this is EPS, and you can click on this and say, well, what's the average 5-year growth of annualized growth in earnings? We do the same thing for dividends, outstanding shares. You can drill down into their income statement, take a look at their revenue as a good example. What's their cost of revenue for everything that they buy, their operating income. So we can take a look at all these different measures of the fundamental quality of the stocks. We also have 3 measures of what we call fair value. So we've used Buffett's measure of fair value. We've used Peter Lynch's measure of fair value. We've also used our own version of fair value. We average all those together, and we give you the current price versus the average fair value, and kind of give you a rating. So you can kind of see if the stock is really trading well above fair value or trading below fair value. We also give you some peers to look at as well. So, well, applied materials is really, kind of overpriced right now. Maybe I should look at some of their competitors as well. Take a look at short interest on the stock as well. Again, this has kind of been a big issue as of late. Take a look at the insider stats as well as the option chain. So again, if you like to trade options, we provide you all of the options chain for that. We also give you a full technical analysis. So this is based on our suite of technical indicators. Kind of gives you a synopsis of what AMAT is, gives you a technical rating based on all of these underlying fundamental technical factors. So we have these technical indicators. We have right now 2 buys, 4 sells, 3 holds, and we break that down by average buys and sells, gives you the pivot points as well for the stock, the average buy rating for that, and of course the technical rating, which right now is a strong buy because it's in a very positive trend. So we try to give you a lot of different tools to help you manage your money better, and also help you make better decisions about the portfolio itself. And then as you kind of go through, you can start taking a look at stock summaries, as I just kind of went through, and then ultimately you can build your own strategy. So if you want to run a strategy that's based on Chaikin money flow and the MACD as your primary buy and sell signals, I'll just give you one based on our money flow indicator as an example. It'll run a strategy and give you the buy and sell points for whatever strategy you want to build for your own portfolio. And you can change the variables, rerun the strategy, see what works, see what doesn't work. We give you 3 strategies that we work with, but you can build your own as you go along and get more depth at the system. But that's basically SimpleVisor as a tool to help you manage your money better. And again, we have lots more innovations coming. A lot of the risk reward analysis that we do, we're going to be adding to the site, as well as new portfolios as well. And again, we're always taking comments and questions from our users and trying to bring more tools and more useful services in the future, such as down the road. Over the course of the next 12 months to 18 months, we're going to be adding financial planning, insurance planning as well. So as you're in here, and also 401k plan management. So as you're in here, you'll be able to start doing some basic insurance planning, some basic financial planning, and even have a process to manage your 401k plan at work, just to give you a model to compare to, so you can have better control of your 401k plan at work.
Well, that was pretty amazing, Lance. We let the data and chart geek out of the cage, and man, did he just run wild. That's phenomenal. So a couple of things. If you are an experienced DIY investor, this has got to kind of feel a little bit like a kid in a candy store. There's just so many tools, and so many resources here. You know, I remember from my days in investment banking on Wall Street, you know, everybody back then crowded around the one Bloomberg terminal that the firm had, you know, on each floor back then. Now most professionals have their own Bloomberg terminal. I just went and checked the pricing. It's still about $2,000 a month, $25,000 a year. I can't imagine, for the average DIY investor, I can't imagine them to have needs that aren't already completely or almost completely met by what you just walked us through. And you said you're going to continue improving it. And the cost is what, $30 a month?
$30
right?
a month. Yeah, it's
Yeah,
$29.95, right?
$29.99. Okay, yeah, versus 2,000-ish or so. So phenomenal value. And for people who are maybe just starting out, you know, they're maybe not super knowledgeable yet, or they're in the accumulation phase before they can graduate to a live financial advisor who can manage their money for them. If your eyes started glazing over, folks, don't worry. You can just use the very simple parts of SimpleVisor to work the accumulation phase, but you then have this very, very wide sandbox that Lance walked us through. Along your journey, you can start learning, to the extent that you want to, about all the other aspects of how the market works, or whichever ones interest you. And of course, if all you're trying to do is just get to the point where you graduate, where a financial advisor can then take over the whole thing for you too, that option obviously is still available to you. But kudos to you and the team there for building all that, Lance. That must have just taken forever.
It did. It's definitely a labor of love, and but again, it's we're trying to provide. And look, I agree with you. It's a bit overwhelming because there's so much there. But we're going to be doing a lot more videos after we get everything launched and operating the way we want it. We're going to be doing educational videos along the way, and trying to start breaking down stuff into segments to help people use it more efficiently. But again, this is just part of that evolution stage. Because again, a lot of these tools that we built, like all the relative rotation stuff, the relative analysis, the macro factor performance, that's all stuff that we built internally for ourselves. And we was like, hey, if we use it, maybe somebody else will use it. And so that's why we give you access to it.
Oh, absolutely. Okay. And I just want to show folks how they can actually get it. So folks, if you're watching, just go to thoughtfulmoney.com, type in your email address. So you put that here into the box here. You'll be presented with this form. It's very short. Just type in your name, where you live. To Lance's point, if you want to use SimpleVisor and you're outside the US, let's say in Australia, just pick any American state here and it'll put you through the system. But when you get down here to what are your top financial goals, just say, I'm interested in SimpleVisor. And then when you scroll down a little bit further, and it says, are you already set on being matched with a specific advisor? Just click Lance Roberts and RIA Advisors, and then when you hit the submit button, it'll go straight to Lance and his team, and they will have a specialist there connect you with the SimpleVisor platform and get you set up. And of course, they're going to want to find out kind of which of those buckets you fall in. Are you somebody who just wants access and you're going to run wild? Or if you're somebody who wants to set up the simple accumulation version and whatnot.
Yeah.
But anyways, Lance, just again, kudos to you and the team. Super excited. So glad that we finally are at the point where you could kind of unveil it to the world. I understand why you wanted to wait until it had as many of the bells and whistles you wanted in there, because it is an incredibly impressive selection of resources there and very well designed. As a guy who's used Bloomberg Terminal, I always find it's almost like working in DOS,
Right.
where
Yeah.
this is just so much more user friendly. All right. Well, look, folks, any parting words on SimpleVisor before we wrap it up, Lance?
No. Again, look, it's a 30-day free trial. Try it out, and if you don't like it, just make sure and cancel.
All right. Well, look, no rant this week, folks. And Lance, I know you actually had another important topic you wanted to get into, sort of a response to Jim Grant's appearance on this channel and where he thinks interest rates are headed. Don't want to give you short shrift to cram it into the last couple of minutes here, so we'll do that next time around. But folks, if you've enjoyed this, obviously, if you found value in SimpleVisor, go check it out. But if you've enjoyed Lance playing Santa Claus here and bringing us a wonderful new present to the world of investors and would like him to continue to do that going forward, put the pressure on him by hitting the like button and then clicking the red subscribe button below, as well as that little bell icon right next to it. And a reminder, we're getting closer and closer to that 100,000 subscriber milestone. I think we're still about 6,000 away. So if you've watched this video and haven't subscribed to this channel yet, please do that. Hitting that milestone is going to be really important for us. And I will end it there. Lance, buddy, great week as usual, but again, great achievement with SimpleVisor.
Thank you. I do appreciate it. And again, I hope everybody enjoys it.
All right. Thanks so much, buddy. See you next week. Everybody else, thanks so much for watching.